Hey guys, Mike here. So in today's video, this is going to be a little different because I got a lot of requests from you guys about finding ETFs that could take advantage of the new infrastructure bill, as well as just trying to diversify your portfolio. Again, this is not financial advice. You got to make your own decisions. I'm not telling you to go buy any of these. Okay, there's 3 of these I actually really do like. But you got to be the ones to make that decision if that's what you want to do. And so I found one, actually I got 9 of them total, but they cover all the sectors from transportation to building to EV to tech to clean energy. And so I think I got it all covered for us. And I tried to find affordable ETFs, anywhere from $20 up to $80. I think it's the highest one, I believe, because these things can get way more expensive, okay? And make sure you pay attention to the expense ratio on these things, the price, and then of course the holdings. And so that's important to think about when you're trying to think about which one of these you want to invest, or if you want to invest in any of them. And trust me, you shake a stick, you hit an ETF. There are so many of them out there. It's crazy actually. But anyway, I think you're going to like this. So if you get anything out of it, hit the like and subscribe button, and only if you get anything out of it, by the way. And if you want to open an account with Webull, you're going to hit the link down there in the bottom. You get 2 free stocks. We get a free stock. And we appreciate your support of the channel as always. And you know me, let's go ahead and get into it. And so the first infrastructure play really is PAVE. And so this is the one that actually holds companies in it that build big like dump trucks and 18-wheelers and things like that, and material suppliers and things of that nature. You can see it's going for about $25 today. And in the last year, I mean, it's ran up 98%, which is really nice. That's without an infrastructure bill being put in place. Has an expense ratio of 0.47%. What that means is every year for every $1,000 you have invested, you have to pay $4.70, which doesn't seem too bad. Just pay attention to that because some of these are higher and everything. Pays a dividend semi-annually. And we just scroll down. Remember, I don't sell stocks or ETFs on this channel. But one thing Seeking Alpha actually does is they put these ETF grades on here. And so momentum, they say it has an A, expenses are C minus, dividends are D minus because they just don't pay a big dividend. Risk is B plus because it's not super risky. And asset flows are an A plus. So it actually gets some pretty good ratings there. And if you look at the price return over the last 3 years, around 59%, and last year was 98%. And then breaking down its holdings, it has 72% in industrials, basic materials are 19%, and then technology around 5.2%. Utilities and energy, you can see the breakdown here. And you see the top 10 holdings, Deere Company, which is obviously a big company, Eaton Corp, Norfolk Southern Corp. So all these are big, either utilities, suppliers, truck builders, things of that nature, like Vulcan Materials. That's a big supplier of the materials you need to build roads and bridges and things like that. And looking at some of their other holdings, you got Fastenal, which rents and sells tools and things you need for this. You got Trimble, which actually is Ark's #1 pick, and their space ETF, but this is software for building. United Rentals, they rent forklifts, things like that you actually need to complete the infrastructure projects as well. And as you can see right here, Steel Dynamics, Reliance Steel, so you got a lot of steel manufacturers which you're going to need to actually do this with. And so as you can see, I mean, PAVE gives you that diversified investment if you're looking to take advantage of the infrastructure bill. And to be honest with you, look how well it performed in 2020, and it's not even a high growth stock or a tech stock or anything. And there was no infrastructure bill put in place, and it has a decent expense ratio, very diversified. So I actually do like it as an investment. And so it's important to know on these next ones we're going to go over, these are clean energy ETFs. And these things are getting really popular, okay? In the first quarter alone, I think it was like $50 billion worth of shares were traded of clean energy ETFs. In the fourth quarter, it was $25 billion. And so they're getting very popular and ramping up because, well, people know what the future is, and they like to have this diversified instead of trying to pick out one clean energy stock. Just have a whole basket full of them and see where it goes from there. And so let's go ahead and get into those. And these right here have absolutely been hammered in the sell-off. And so the first one is QCLN, the Clean Edge Green Energy Index ETF, trading for $67. Has an expense ratio of 0.6, pays a quarterly dividend. And if you look, I mean, it actually ran up in 1 year 221%, but as you can see over the last month, still up about 2.4%, but it got killed in the sell-off. So, well, I wouldn't say that because, I mean, compared to the stocks themselves, it's pretty bad. But if we look up here, it's gone from 88 down to 67. So it gets hammered right along with it. If you look at the grades, you got an A plus for momentum, D for expenses, C for dividends. Risk is high, so it's a D. And asset flows are an A+. And we look at the returns on the price, because obviously it's going to be skewed because of 2020. But you got the 5 years, 349%, 3 years, 241%, and 1 year, 221%. And the way they break those down, you can see right here, the top holdings are in technology at 43%, and after that it's consumer cyclicals, and you can see the rest of them broke down. Top 10 holdings, which are going to be very popular, is Tesla, NEO, Enphase Energy, we know, Plug Power, On Semiconductor Corp, Solar Edge, Brookfield Renewables. So it's all of the basically high growth stocks out there, and that's why it goes down fast and up fast. And we take a look at some of the other holdings. You got Sunrun, First Solar, XPEV's in there, Next Era Energy Partners, SunPower Corporation, Fuel Cells even in there. So again, these high growth stocks are in this one. So when it runs, but in a time like right now, it's just sitting there selling off and consolidating right now. And the other one that's a lot like it is ICLN. It's cheaper. It's around $23.55. Expense ratio of 0.46%. It pays a semi-annual dividend. As you can see, it ran up 131% in 1 year. But if you look at the last month, you can see, actually we'll go here and just look. It was a high of 32 and it sold off down to 23. So since the sell-off started happening. And you can see the grades: A for momentum, B for expenses, dividends a D, so it's not a very good dividend. Risk is big time, so D-, and asset flows are an A+. And you can see the returns, not quite as good as the other one over here, over 100% for the price returns either way. But they have their holdings a little different, where they have utilities at 47%, and then technologies 29.37%. And in this one, you won't see EV vehicles, because you got Plug Power as the number one, Enphase Energy, First Solar. And so as you can see, between those two, you got one which gives you EV exposure but still gets the wind and solar, and the other one is just strictly wind, solar, which of course I think to me is why it's on the lower price side. But that one you have to make your mind up on. The expense ratios aren't bad, obviously well diverse, and if the infrastructure bill passes, but especially if we get a lot more incentives passed for alternative energy, obviously these should do well. But as you can see, they sell off same way all the high growth stocks sell off, because they hold a lot of them in there, and so a whole lot of speculative stocks in there. And so it's something to keep in mind if you're thinking about that. So the next one we're going to is transportation. So this is actually building the roads and bridges and things like that. And so this is really a bet on the infrastructure bill. And so the first one is XTN. It's a S&P Transportation ETF going for $88.25. This is the most expensive one on the list. But you can see over the year, it actually went up 102%. And if you even look when the sell-off happened, you can tell people started rotating. The sell-off started happening here, and it actually went up. And so low expense ratio, 0.35%, pays a quarterly dividend. And so if we scroll down, you can see, its dividends are A+, momentum's an A, expenses are C+, risk is C-, and assets flow gets an A. And you can see last year, obviously it's probably one of the best years I had, if not the best, 102%, 3 years out, only 43%, 5 years around 100%. And theirs is easily broken down to industrials at 95%, and technology is only 5%. And the top 10 holding, you're going to see a lot of companies you recognize. Kansas City Southern's a big one, Avis Budget Group, FedEx, Union Pacific Corp, Norfolk Southern Corp. And going something a little bit cheaper, FTXR. It's a First Trust NASDAQ Transportation ETF. And you see 1 year is on 117%. And even during the sell-off, there's another one people started rotating into. It actually has gone up. A little more expensive at 0.60%. Does pay a dividend, nowhere near as much as the other one though. And you'll see that in the grade. Momentum has an A, expenses a D+, dividends D-, risk is a C, asset flows are an A+. And you can see his returns here. I think 2020 obviously was an anomaly for this one, because you see the 3-year return is much lower. And this one right here actually only has 70% industrials and 24% in consumer cyclicals, which you can tell people were rotating into what? Industrials and cyclicals during this whole sell-off. And there's a little difference. You see up here, you see Blink Charging at number 2 of their holdings. So they do actually have a charging infrastructure. PACCAR, you might actually recognize, because this is the one right here that just signed a strategic partnership with Romeo Power just the other day. And so that's why you might recognize that name. And so this is a little more aggressive, but you got General Motors, FedEx, United Rentals, United Parcels. So, you see some big companies in here as well. And their top 10 holdings make up 56% of this fund. And so it obviously gives you two different choices on that one. One is much more expensive, one is less expensive, and one pays a pretty nice dividend compared to the other one. The expense ratios aren't that different. Obviously, you see the companies are a little different. One's a little more aggressive going into Plug and PACCAR, who just signed an agreement with Romeo. And so a little different on that, but still have very stable companies in the portfolio as well. And so it gives you that. The next one, I have one for you guys on 5G. And this one's called Defiance Next Generation Connectivity, ticker symbol FIVG, only going for $36. And you see the 1 year is a lot less than the rest of these, only gone up 59%. As you can see in the last month, it's actually only gone up 8%. And so, because as these 5G stocks have sold off, so has it, but not as much, obviously, because of diversification. Low expense ratio, 0.30%, pays a small quarterly dividend. As you can see, momentum, not a whole bunch. B, expenses B minus, not bad. Dividends D, because its dividends pathetic. Risk is C plus, and assets flows are a B plus. And you can see this is a much newer fund. It was only started in 2019. You got 59% on your year one, so obviously there is no 3-year, 5-year returns. And the breakdown, technology is obviously going to be 75%, communications 15%, and it has some real estate in here, which you're going to need if this infrastructure bill gets passed, because remember, they're going for, obviously, everybody having connectivity through the internet and things like that. That's why they want everybody to be connected in this infrastructure bill. So this one should absolutely benefit as one of the most of all of these ETFs if that bill goes through. And you can see right here there's going to be a lot of semiconductor and chip makers and things like that, a lot of tech. So NXP Semiconductor number one, got Qualcomm, Skyworks, AT&T, Nokia. And so you got a lot of companies you know on this, and they have more semiconductor holdings than that. And their top 10 holdings only make up about 38.74%. And just looking at some other holdings, they also have Verizon, T-Mobile, Maxim Integrated, we know, Marvel Technologies, Intel Corp, Cisco, NVIDIA, Apple, Amazon, Dell, Hewlett Packard. And from what I read, and my understanding is this is the first 5G ETF ever created. As you can see, it was created in 2019, so there is no past performance to base anything on. Who knows how this is going to do? I can only imagine as 5G grows, especially if this infrastructure bill gets passed and we're able to start building out the network in the United States, how much this will actually move up, because it actually had, an okay performance in 2020, right? But, I'm waiting to see what happens in 2021, 2022, the companies that's holding right now in the fund. And so I don't think, obviously, is it going to 5x or something? Of course not. That will be years and years from now. But, remember, all these funds that are $300, $400, $500, they didn't start off $300, $400, $500, most of them. They started off much lower and then just grew over the years. So it's something you kind of got to be patient with, and the expense ratio isn't that high. And I definitely like the diversity of it and the companies it holds. And so the last two we're going to go into is going to have a lot of exposure. They give you a diverse crowd of automobiles, EV, anything to do with EV, and then just some really big tech companies, blue chip tech companies, actually. And so the first one's called Drive, DRIV. It's a Global X Autonomous and Electric Vehicles ETF going for $27.32, very reasonably priced. Had about 134% gain in the first year. As you can see, actually, as everything else sold off, starting to sell started actually here. It definitely sold off, but nowhere near as much, and you'll kind of get to see why. Has a higher expense ratio of 0.68%, pays a semi-annual, very low dividend, so I wouldn't try to buy a new house on that or anything. Momentum's A+, expenses are D+, because of the expense ratio, dividends D- because it's low. Risk is B-, which kind of surprised me. I think you'll see why. And asset flows are A+. And you can see the inception of 2018, so this is another young fund. Only has $671 million in assets. And you see the first year, there's no 3 or 5 years. It was created in 2018. And if you look how it's diversified, you got technology at 35%, consumer cyclicals at 33%, industrials at 16%, And so if we move down to the top 10 holdings, you're looking at Intel Corp #1, which surprised me, Alphabet, Microsoft 2 and 3, which surprised me. And then you got Nvidia, Toyota, Apple, Qualcomm, Tesla, Cisco, and Micron. And then if we look over at the other holdings, you're looking at General Motors, Honeywell, Volkswagen, another semiconductor company, Ford, Advanced Micro Devices, Honda, Kia, Panasonic, another semiconductor corporation, NEO. And so obviously anything to do with EV is in here. Anything to do with automobiles is in here as well. And then you got those big tech companies like Google, Microsoft, stuff like that to kind of stabilize it as well. And so if you go into the other one, you're looking at a little more expensive one. This is IDRV. It's an iShares self-driving EV and tech ETF. It's about double the price, around $47. Returned about the same return, 118% over the first year. And if you look at the last month, you can see, obviously, it sold off just like the other stocks have done, but it's made a nice comeback. And the reason why is because you see Google and them coming back, Microsoft's been coming back. And so the expense ratio is a little lower at 0.47%, semi-annual, very small dividend, not anything to write home about. Has momentum A+, expenses are a B, dividends are C-, risk is B-, which really surprised me, and assets are A+, so very good ratings. And this is another very young one. It started 2019, only has 335 million on the books there, and you're looking at 118% first year return. And you see the way they're broke down. Cyclicals are actually #1 at 43%. Technology is #2 at 38%. Then you got some industrials and basic materials thrown in there. And this is very similar to the other one. They're almost like a copy of each other. Intel is #1, Alphabet's 2, Toyota is actually #3. Tesla's up on this list though at #4. And so, but you see all the car companies, the chip companies, a lot of semiconductor companies in this one as well. If you look over here, you see AMD, you got Volkswagen, Ford, Honda, NEO, Volvo, LG Chem, Samsung, Hyundai, Porsche, BYD, XPEV, Nissan. And so that kind of gives you a big basket of diverse ETFs. Obviously, those two give you pretty much exposure to every car company out there that's trying to go EV, almost every semiconductor company, the big ones like Google, Microsoft, Apple, all in there as well. And so, you know, my favorite three personally that I'm looking at, because I like the price, expense ratios and things like that, I like Drive, PAVE, and then I want my 5G exposure with FIVG. I guess you can call it 5G. I like that as well. But that's just me. I definitely want to know, you know, what are your favorites? I know there's so many out there, so you can put them in the comments. There's some you really love, especially if you're trying to play on the infrastructure bill or you're just trying to play on the future as far as clean energy, EV, and things like that. And so let me know your thoughts. Hope you got something out of this. If you did, please hit that like and subscribe button. It really helps the channel out a lot. Definitely appreciate that. Again, if you need to sign up for Webull, you hit the link down the bottom. Really appreciate your support of the channel, and let me know how you like it. And having said all that, I will see you guys Saturday.